Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. It's the crucial RBI MPC day, and just as we end this eventful week, from the political games, be it in South Korea or in France, to the move in currencies, especially the rupee, which has been trading at its weakest level and keeping investors at the edge. And not to mention, amongst this mix is the various announcements by President elect Trump, which has been keeping investors anxious. Good morning, JK. How do you think the markets are placed ahead of the MPC and your expectations from the meeting today?
Hey, good morning, Swaraj. Yeah, I think this MPC meet is quite different from what we have seen over the last several meetings. And what surprises me is that suddenly a minority is even expecting a rate cut today. I am not in that camp. I don't think it's likely given how high the inflation has been, but that's where the market expectations stand. But a near consensus is on a cash reserve ratio cut by 0.25%, which is likely to release 55,000 to 60,000 crores into slightly liquidity-starved market. So, but I think the projection on growth and inflation are likely to undergo revision. Uh, Obviously, the GDP will be revised downwards for the full year, I think, and the CPI for full year is likely to be revised upwards towards 4.7, 4.75. Can't ignore the cyclical slowdown that has deepened in the last 2 months in the Indian economy. Therefore, I think these are my expectations from the MPC. I do not see a major impact from the MPC outcome on the markets, particularly the rupee, unless there is a surprise rate cut, because even rupee is already under weakening pressure, and any softening of yields in India will be to its disadvantage vis-a-vis the US dollar. Therefore, I think RBI is very much mindful of the same, and having already spent so much of reserves, I think their job will be even more difficult if they let the rupee fall with a rate cut. And they cannot ignore the fact that inflation is already above 6%, the maximum ceiling, and economically it won't be justified to cut rate. But yes, liquidity infusion is something that I would agree with. On the global market, we had a set of weak US data yesterday. The ISM services was much weaker than expected, although it is still in the expansion territory. But the contributors have been lower new orders, lower employment, and lower supply deliveries. And of course, the price pressures remained almost at the high level that was seen the last month. The other number was the weekly jobless claims, which increased, in the previous week by about 9,000, and this is an increase that's happening after several weeks of lower number, but still it is a strong number. However, one should view these jobless claims data with a slightly different perspective, because the week-on-week number lower indicates that the people out of jobs is not increasing much, but people who are already out of jobs have not been able to find the new jobs in a hurry, and that's why the continued claims continue to be quite high. Therefore, I think the labor market continues to indicate mixed signals. We also had the employment indicator mixed in the ISM. Therefore, I would take these numbers with slight caution on the US economy, but nothing to threaten the strong US economy or the US dollar as of now. On the Europe, where there is a lot of interest after the French government has fallen with confidence motion being held up, the Prime Minister has tendered his resignation while the President has asked him to continue till the new PM is appointed. But markets have actually seen a rise in the euro after this event because that seems to have discounted the worst scenario, at least for now. What can get worse than this is if the money market stress or the fiscal problem in the French economy spills over to other economies like Italy or Greece. So as of now, market is not anticipating it, and therefore, and has a confidence that the authorities would be able to manage it well before in sort of crisis erupt. So euro has found some short covering. Already seen 1.0580 after seeing a low of 1.0333 last week, and then I think the recovery can extend some more towards 1.0650 as well. On Japan, one of the key dovish member actually has indicated that a possibility of rate hike exists this month, and their wages are rising and inflation is above their target. There is very little justification for continuing to be at a low rate of 0.25%. And I think the authorities have managed to keep the market expectations low, and therefore there is no speculative buildup. Of course, if they do hike, there can be some knee-jerk reaction in the stocks as well as in the dollar. However, I think it may not be as violent as we saw back in July when they hiked rate to 0.25%. Interesting development in oil prices. We had U.S. Crude oil inventories being down more than expected, and then yesterday OPEC decided to extend their production cuts into next year, and not to think of any increase in production for the time being. Despite that, crude oil has come off about 1.5% overnight, and this is due to two factors. Now, structurally, the demand for crude oil has been coming down. Global oil production is at its peak, and at this level, US is planning to produce more. So there is a pressure on OPEC prices, or rather the crude oil prices, which I think is likely to continue. Today, we have, of course, the jobless, rather the monthly jobs data from US non-farm payroll and unemployment rate. Non-farm payrolls are expected in the region of 150,000. Unemployment rate is expected to inch up to 4.2% from 4.1%. Now, these are not likely big impact makers, but if there is much lower number, that can actually see the dollar some more long liquidation. Market also likes to look at the household survey, which is actually giving a much dire picture of the employment situation, because the official surveys are actually made up more of part-time workers and temporary jobs, as well as it may include the people who are off the job due to strikes and hurricanes. So household survey, the trend in household survey will be something that the market will not ignore. So overall, I think the dollar, for several reasons, market may see the dollar give up a bit more for the time being, and until it finds fresh reasons to buy the dollar. And we are already into the month of December, and data shows that out of last 10 years, only 1 year dollar has gained in the month of December, and on all other months, on an average, it has lost about 1%. History need not repeat, but it can rhyme. So interesting time today, and as well as for the rest of the 2 weeks until the Fed meeting. Thank you.
Thank you, JK. And the crucial MPC meeting will be held today, and it's expected that there will be a cut in the cash reserve ratio, which will provide liquidity to a liquidity-starved market. The inflation and growth projections will be closely looked at since GDP figures released on Friday was quite low compared to the expectations. When it comes to global market, there was a set of weak US data starting from ISM services, which was weaker than expected. Lower new orders and lower employment has driven the dollar also lower. Euro has also strengthened despite the political issues in France since its well discounted move. A possible rate hike in Japan is finding its ground since inflation remains a point of concern, and this has been voiced by various members of the Japanese central bank. When it comes to oil, OPEC decided to extend their production cuts till next year. Despite this, crude oil has come off as global oil production levels are at its peak, especially from the US, which is expected to increase their production even at these prices. That's it from us today. Thanks for listening. Have a very good weekend, and we'll see you all on Monday with a fresh round of updates.